Welcome to the Deep Dive, your express route to becoming well-informed. Today, we're taking a close look at one of the big consumer goods giants, their latest results, their strategy going forward.
Yeah, we're pulling this straight from their recent earnings call and press release. That was July 29, 2025. So it gives us a pretty full picture of their fiscal year 25, which just ended, and well, what they're expecting for fiscal 26. Our mission here, really unpack the numbers, understand the big strategic moves, and point out maybe some surprising things, so you can quickly get a handle on where they're headed in this, frankly, pretty volatile global market.
Exactly. And it's so important, like you said, to look beyond just the headlines. There's often a lot more going on underneath. What we'll talk about today should really show you not just what's happening, but why it actually matters for consumers, competitors, the whole market, really.
Okay, let's dive in then. And there's some pretty significant news right off the bat, a leadership change. John Mueller, after, wow, 38 years, he's moving to executive chairman of the board. That's effective January 1, 2026.
38 years is quite a run. It really is. And stepping up as the new president and CEO is Shilishi Jujubakar. He's also a long-timer, 36 years with the company, 12 on the leadership team. Most recently, he was chief operating officer running the enterprise markets, with full P&L responsibility.
And what's interesting is how they frame this. They call it thoughtfully planned. It signals not just a smooth handover, but real depth in their leadership. Highly capable and experienced, as they put it. Mueller even said something like leading these huge companies is a we sport, not a me sport.
Emphasizes the team.
Right? And it connects directly to their performance over these last 7 years, since about 2018. I mean, look at the numbers. Over $17 billion in new sales. That's like 84th percentile in the S&P 500. Plus $6 billion in extra profit, 92nd percentile. And $180 billion added to their market cap. So this planned succession, it speaks volumes about stability, doesn't it?
Absolutely, a strong legacy there. Okay, let's pivot to the numbers for fiscal 25, the year ending June 30th. Top line, net sales came in at $84.3 billion, basically flat compared to last year. But, importantly, organic sales did grow by 2%. That was split evenly, 1% from volume, 1% from price and mix.
And if we drill down into core EPS, that's earnings per share, kind of stripping out the one offset, that grew 4% for the year to $6.83. And even taking currency swings out of the equation, that currency-neutral core EPS was also up 4%, solid underlying growth.
Good point. Looking across the product categories for the year, mostly growth. 9 out of 10 categories saw organic sales go up. Mostly low single digits. Baby care was the one exception, down low singles.
And regionally.
Right, regionally for FY25, focus markets up 2%. That includes North America at plus 2% and Europe focus markets up 3%. Enterprise markets were also up 2%, led by Latin America, which looked strong at plus 4%. Greater China was the outlier, down 5% for the full year, although they did mention seeing some improvement recently with 2% growth in the last quarter.
China's always a complex picture. But it's interesting to see the strength elsewhere. And also, their e-commerce business keeps growing, right? Up 12%. It's now almost, 19% of their total sales?
19%, yeah.
And they held or grew market share in 30 of their top 50 category country combinations. That shows some resilience. Plus, that fourth quarter, April to June, was pretty strong too. Net sales up 2%, organic sales up 2%, and core EPS jumped 6% to $1.48. That's 5% currency neutral.
And a key driver there, they highlighted this very strong productivity improvement, 560 basis points in just Q4. That's 5.6%.
Huge.
Yeah, and that's what allowed them to reinvest back into the business while also returning a lot of cash to shareholders. $16 billion for the full fiscal year 25 and $3.3 billion just in that final quarter.
So strong finish to the year despite the flat top line overall.
Exactly. Which brings us to their strategy moving forward. How are they planning to keep momentum? They talk about this integrated growth strategy. It seems to have 5 main parts guiding their decisions.
That's right. The 5 elements, just quickly, are a focused portfolio concentrating on categories where performance really matters. Then, integrated irresistible superiority. We'll probably dig into that one more. Third is productivity improvement. Fourth is constructive disruption, shaking things up themselves. And finally, an empowered, agile, and accountable organization.
Okay, that integrated irresistible superiority, that sounds like the core of it. They're saying it's not just about the product, it's the whole experience across 5 things. Product, package, brand communication, how it shows up in stores, and the overall value.
Exactly. And it's not just about being premium. It's about delivering the best total experience, hitting all those points together. That makes it much harder for competitors who might just compete on, say, price alone.
Right. So where are we seeing this in action? They gave some examples, didn't they?
They did. Some really compelling ones. Take Pampers in China. They're focused on the premium and super premium end. Organic sales there grew nearly 20% in FY25, and they gained over 2 points of value share. It's apparently becoming the go-to for newborns among younger moms.
Okay, that's significant growth.
Or look at SKT LXP, also in China, super premium skincare. It has the highest concentration of their special ingredient, Patera. They claim it delivers results 8 times faster. Yeah. Builds that high-end brand image.
And it's not just high-end stuff. What about other categories?
No, absolutely not. Look at Pantene in Latin America. They launched a deep conditioning treatment with these visibly enticing melting pearls. Sounds fancy, but it's driving category growth. Mexico hair care was up mid-teens organically for the year.
Mid-teens, wow.
Or Swiffer. They launched the Sweep and Mop Deluxe, first big upgrade in 25 years. Got 6% new users, 30% incremental sales. And then the Swiffer Power Mop, their biggest launch ever for Swiffer. They use TikTok, AI-tested ads, the whole Mop Smarter campaign. That one product drove 40% of Swiffer's growth and a third of the category's growth.
That's leveraging new channels effectively.
Definitely. And think about Align in the U.S., digestive wellness. They launched specific products for bloating relief, food digestion hitting real consumer pain points. Their 3-in-1 biotic, prebiotic, probiotic, postbiotic is growing share fast. They use relatable messaging, like not being able to button their pants.
Huh, relatable indeed. Any other big innovations?
One more standout is Tide EVO. This is a completely new laundry detergent format. It's based on functional fibers, cleans really well, comes in recyclable packaging, no plastic bottles, no water shipped. In the Colorado test market, they said sales were highly incremental, meaning adding to overall category growth, even at a 50% price premium per load.
Okay, so real innovation across price points and categories. And it seems like the industry is noticing too.
Yeah, the external validation is there. For the 5th year running, they had at least 3 of the top 10 non-food launches in that Circana Pacesetters report for 2024. And for the 7th year, they had the most products in the top 25, more than their next 7 competitors put together.
That's dominance.
It really speaks to their R&D and commercialization engine. And remember that other strategic pillar, productivity improvement, that feeds this. They're targeting up to $1.5 billion in gross savings from cost of goods sold. Things like Supply Chain 3.0, using digitization to cut overhead. That saving gives them the fuel to keep investing in these kinds of big innovations.
Right, it creates that headroom. Okay, so that's the strategy. Now, looking ahead to fiscal year 2026, they're expecting continued challenges, a volatile environment, they called it. So what's their guidance telling us about the next year?
Well, the official guidance ranges are organic sales growth between flat and up 4%. That range includes a small drag, maybe 30 to 50 basis points from discontinuing some smaller brands or products. And for core EPS, earnings per share, they're guiding flat to up 4% again. That works out to about $6.83 to $7.09 per share. The midpoint is $6.96.
Okay, flat to 4% on both. But what are the big headwinds they're facing to get there?
There are a few significant ones. First, commodity costs are expected to hit them for about $200 million after tax. Then, higher interest expenses and a slightly higher tax rate that's another $250 million after tax. But the really big one, the elephant in the room, is tariffs.
Ah, yes. How big is that impact?
It's huge. They're estimating about $1 billion before tax or $800 million after tax in higher costs just from tariffs. That alone knocks about 5 percentage points off their potential core EPS growth.
5 points just from tariffs. Where are those coming from?
It's spread out. About $200 million from tariffs on goods coming from China to the U.S. Another $200 million or so from Canada's new tariffs on U.S. goods. And the biggest chunk, around $600 million from tariffs on goods coming from the rest of the world into the U.S.
Wow, that's a massive external pressure.
It really is. And the tricky part is the volatility. You know, trade deals can change things. New investigations pop up, retaliatory tariffs. It's unpredictable. Their plan to manage it involves, well, sourcing flexibility, pushing harder on productivity savings, and some pricing. They mentioned price increases in the mid-single digits, but only on the specific products affected by the tariffs. Across the whole portfolio, it averages out to maybe 2.5%.
So targeted pricing, not across-the-board hikes.
Right, tied to innovation where possible. But even with mitigation, it's a big hit. On the plus side, they do expect a tailwind from foreign exchange rates, maybe around $300 million after tax. But when you net it all out, commodities, interest, tax, tariffs, FX, It's still a net headwind of about 39 cents per share. That's roughly a 6% drag on core EPS growth right there, before they even start trying to grow the underlying business.
A 6% hurdle just from those external factors, and that feeds into the broader market issues they mentioned.
Exactly. They talked about heightened consumer anxiety.
Mm.
People worried about tariffs hitting their wallets, inflation, interest rates, all the geopolitical stuff. That anxiety tends to slow down overall category growth.
Yeah.
People might just buy less often or look for cheaper options. Plus, the geopolitical environment itself is just unpredictable right now.
And retailers are reacting too. You mentioned inventory reductions.
Yeah, that's a factor. Retailers are being cautious. Sell-in, meaning what the company ships to retailers, is lagging behind sell-out, what consumers actually buy from retailers. This is partly because shopping is shifting more to channels like Walmart, Amazon, club stores, and those guys tend to run leaner inventories anyway. Retailers are basically trying to free up cash, manage their own balance sheets in this environment.
So lots of headwinds. How are they planning to, as they put it, create our own tailwinds?
Well, building that financial headroom we talked about through productivity is key. That lets them keep investing in innovation and commercialization, focusing their firepower on the most important categories and markets. And a huge part of creating those tailwinds is this major 2-year restructuring program they announced back in June.
Ah, yes, the restructuring. What does that involve specifically?
It seems to hit 3 main areas.
Okay.
First, portfolio choices. They're actually exiting some smaller categories, brands, or specific product types in certain markets. Examples they gave were streamlining pads in Asia, cutting some small product lines in oral care or fabric care in specific countries, even exiting Bangladesh entirely.
So trimming the edges to focus the core.
Pretty much. Second is supply chain. They're looking at right-sizing manufacturing, locating production closer to markets where it makes sense, trying to get more efficient, faster, and cheaper. And the third piece is organization design, aiming for a more agile setup, broader roles, smaller teams, leveraging digital tools and automation more.
And this involves job reductions.
It does. They stated up to 7,000 non-manufacturing roles could be reduced over the next 2 years. That's about 15% of their non-manufacturing workforce. It's significant. But they emphasize these are well-thought-out plans, based on pilots they've been running for over a year. It's not a sudden reaction.
Okay, a major initiative. And they expect the benefits, like EPS growth, to ramp up later in the year.
Yes, they said the EPS growth trajectory should be upward, weighted more towards the second half of fiscal 26. That's when they expect the pricing to catch up, hopefully see some category acceleration, and start realizing savings from this restructuring.
Makes sense. Let's zoom in on a couple of key markets. North America, for instance. What are the dynamics there?
Yeah, North America's facing a few things. One, category growth rates have slowed down, like we discussed. Two, those retailer inventory reductions are definitely a factor there, especially with the shift to channels like Walmart and Amazon. And third, they candidly admitted there are areas where they have a superiority gap.
A superiority gap, meaning they aren't the best option.
Essentially, yeah. Areas where they feel competitors might have an edge or where consumer needs aren't being fully met by their current offerings. They mentioned the value tier in baby care as an example, or maybe their core Olay jars, places they need to step up.
So how do they plan to fix that? How do they widen the gap again?
It comes back to innovation. They pointed to how Love's Platinum Protection helped turn around baby care share, or how new Olay products like Super Serum are specifically designed to bring in new, younger users. And they also talked about tapping into underserved and unserved consumers. They think that's a $5 billion opportunity just in North America.
$5 billion. So finding new needs, new consumers.
Exactly. Not just fighting over the existing pie. It's about expanding the market or meeting needs that others aren't addressing.
Okay. What about China? Sales were down for the year, but that Q4 uptick sounded promising.
China is looking better, according to them. The market itself seems to be on a more positive path. The channel mix is becoming more balanced, not just relying on one type of retail. And crucially, their local team has apparently made real strides in adapting how they operate there. Go-to-market, distributors, media, innovation specifically for China. And you see bright spots like SK2 growing 23%, baby care growing consistently. So progress, but still a market in transition for them.
Got it. Now, a really big question in this environment is about consumers trading down, affordability. Are they worried about their brands becoming commodities?
You know, it's interesting. They explicitly said they are not concerned about commoditization. Their reasoning is fascinating. They pointed out how low consumer satisfaction actually is in many core categories. Only 25% happy with their laundry detergent, 50% experiencing diaper leaks, only 30% happy with feminine care protection.
Those numbers are surprisingly low.
Right, so they see that not as a threat, but as a massive opportunity.
Hmm.
Their strategy isn't just about premium, it's about better innovation, better performance at adequate value.
Hmm.
Superiority, in their view, applies across all price tiers they compete in. So Love's needs to be superior in the value tier, Gain needs to be superior in its segment. They're actively looking at formula changes, packaging tweaks, manufacturing efficiencies, all aimed at making superior performance more affordable.
So value and innovation can go hand in hand.
That's their core belief. It's not an either.
Okay, one last area. Personal healthcare. What's the plan there? Is it still a focus?
Definitely still a focus. They see lots of organic growth potential there driven by innovation and expanding into new countries. They also mentioned being open to more acquisitions, but only if they significantly improve the growth rate and margin structure. Others. They pointed to the German Merck OTC business they bought a few years ago as a good example, something that added scale and high margins through synergies. So selective M&A is on the table.
Okay, so clearly a lot going on. As we wrap up this deep dive, it's obvious they're navigating a really complex world right now. Lots of challenges, but also, well, significant opportunities.
Absolutely. What really stands out is that they aren't just reacting. They're doubling down on that core strategy, and they're making proactive, sometimes tough moves like the restructuring specifically to free up resources to invest in innovation and try to widen their lead, even with all these headwinds blowing.
Which brings up, I think, a really interesting question for you, our listener, to think about. In a world that feels increasingly uncertain, with pressures like tariffs, inflation, how much value do you personally place on those trusted, established brands? Especially the ones that keep pushing for better performance, better value, even when things get tough externally. It's definitely something worth considering.